Hi everyone, welcome to my YouTube channel. My name is Tabitha. If you're new to this channel, subscribe for more videos. Today we are going to talk about perfect credit score. How do you get to that perfect credit score? Because you have financial plans that you want to buy a house, you want to buy a car on credit. So most of the time, even if you have a lot of money and you want to buy a house, the bank that need to give you a mortgage will want to check your credit score. It doesn't matter whether you have half or 50% of the money that you need to buy a house. So credit score is very important. So subscribe for more videos if you're new to this channel, and you will learn from us, and maybe we'll learn from you too. So how do you make that credit score perfect? How do you make the credit score perfect? And you have to look at all the components that make up a credit score for you to make that credit score perfect. So we have different type of components that make up the credit score. Once you miss one of them, and then your credit is affected. You cannot only win on one section, because they have to mark you on all the different sections that make up the credit score. So let's look at the agenda of today, and some of them is like how important it is for you to have a good credit score. Is it that important, and why do you need it? And again, has to look at the components that make up the credit score. So what are these components, and how should you use your credit card so that you can have a good credit score? And then the issues that come up with the credit score. So let's move ahead and look at the importance of credit score. Why is it important? Lenders, they use it to check your credit worthiness, and if you are actually a responsible person who pay your credit on time, dealing with other different lenders. So do you pay your credits on time? If someone trusts you with their money, do you pay them back on time, or do they have to call you? Do they have to report you to collections and all those stuff? So the lenders use the credit score to determine your credit worthiness. It's also used for landlords when they are determining the tenant that they want to choose to rent their property, because most of the time we have problem people not paying their rent on time, and to the point like the tenants will have to, the landlord will have to report them to the tenant board, landlord and tenant board, so that they have to pay, to the point that they have to be forced. So some landlord, they will use the credit score to really see if you are a responsible person who paid the rent on time, and then they will use that. Applying for certain job, there's some certain job when you have a bad credit score, they will not really take you, they will not take you. They also use to qualify for the best interest. You will pay lower financial charges on credit card balance and loan. Credit score components. So we have different type of components that make up the credit score. First of them, first of all, we have to pay on time. That's one component that make it up. So once you borrow someone else money, pay it on time. The credit card is under your name, but the money is for the bank, is for someone else. And if you paid on time, you will also save money on interest. You don't have to pay interest. You will be using someone money and then give it back to them without no interest, but you are building your credit score at the same time. So do not miss any payment. If you can't pay the full amount on time, and then for you to avoid late payments, you can set your minimum payment on auto pay, and most of the time the minimum payment is just only $25 for you to avoid late payment. So you do that and have more of your credit. If you have more of your credit, you are less affected than someone who have less credit. the components of credit score, we're still working on that. So, and we are now on the components number 2. So this number 2 is talking about credit utilization. Sometimes people think like, oh, once they if they have credit card, and then they can use like 25% on this, 25% on that, 25% on that. No, so you have to like add up all your credit available, and then now use less than 25% for you to be given that 35% that make up your credit score. 25 less than 25% will help you build your credit score, boost your credit score, because if you use more than that, and then it will affect your credit. And in this point of credit utilization, which is point number 2, it's not the dollar amount that they really cares about. What they care about is like the amount, the percentage that you use to do when you're taking credit out of your account. So I'll give you example to clear that up. So it's how much percentage do you use is what matters, not the dollar amount that you use. So I have 2 examples. One that shows the credit that has $1,000 available, credit available, and then the one that has a 10,000 credit limit. So for the first one, you have the credit card with $1,000 limit, but it happened that you need $1,000 today and you use it. So what happened is you have used 100% of your credit limit, so which give you 100% of credit utilization, which is bad. So if it's bad, and then it drop your credit score. So you should use only less than 25%. You're using 100%. So that will affect your credit score. The next example is when you have more credit available. If you have a credit card with 10,000 limit, and it happened today you won $1,000. So how much percentage of your credit limit have you used? So if you take $1,000 and you make the calculation, you only have used 10% of your credit available, which is not bad. It's actually lower than what is required for you to use. So that's the difference. So if you don't want to mess up the credit utilization part of your credit score, and then maybe sign up for a credit card that has a higher limit. So if you use $1,000, it won't really affect your credit score. Then we are still on the components of the credit score, which is still credit utilization. Like I've said before, it make up 35%, and if you have a higher credit available, the better, because it will reduce the percentage of credit utilization that you use. Have a lot of credit available, which is the point that I was pressing. If you have a higher credit available, and then the percentage that you use will be lower. Do not keep any balance. If you do not keep any balance, and then most of the time the credit bureau do not even know that you use your card and you took all 1,000. If you paid without waiting until that time that they have to report on your credit, and then they won't really see, there will be zero utilization because you have already paid it back on time without that period, because there is a period that they have to send your credit card activities, and then they will score you. As for credit limit increase, if you don't want to mess up your credit utilization percentage, let the credit card that give you money increase your credit availability. And then the next one will be point number 3, the things that make up credit score. Is the length of the credit history. For a lot of people, they are encouraged to start building their credit as soon as possible. if you're a high school student who is like 18 years, you have that credit card, start building your credit history. And most of the time it's recommended that most of your credits should have like a history of 9 years. This doesn't mean like you being in a bad debt, no. So you have them, you use them responsibly, and you build your credit every time. And a good credit will have you that leverage way of using other people money to make you more money. So that's one of the important part why you want a good credit score. The next part of the credit history is that the thing is the total line of credit. The total line of credit that you have make up 10%. This shows the diversification of your credits lines. So if you have a credit card and the next time you're signing up, you can sign up for a line of credit instead. Or maybe you have a mortgage, that mortgage also represents a different line of credit. And that will diversify your credit lines, and that make up 10%. So those people have different kind of credit, and then they get 10% of that part. And with the credit card line, the higher the limit, the better. And every time you have a higher limit, it will lower the credit utilization of your card. And that's if you have a lower credit utilization, and then it help you build your credit. And then the last point of this video is that if you do a lot of credit inquiries, and then that will really affect your credit, because every time they're seeing you like applying for BMO credit card, applying for CIBC credit card, you're applying for this loan, you're applying for this loan, you're applying for that loan, you're applying for this loan. This shows like you are not responsible, and you might have some financial issues. And because you're applying and applying, they might think like if they give you the money to buy something, you might end up not paying back because you have a lot of credit all around. So minimize the applying for new credit card. If you already have the credit card, use them responsibly, and then you will be good to go when it comes to credit score. So this is the end of the video, and if you're new to this channel, subscribe for more videos.